Just a reminder to anyone in the audience, if you have a question, please try to submit it now. Here's a question from the audience. Will there be, from Jeremy, will there be political will and courage to undo the Fed's errors in the next few years? Or will the problem continue to compound because nobody wants the downside risk of what potentially could happen?
I think there's a real danger that we will delay addressing the current issues. That is our debt issue, for example, which was in 2010, our federal debt was about $10–11 trillion. Today it's 30 trillion. I think it announced today that it went over $30 trillion. So we will be reluctant to address that because it means constraining spending or increasing taxes or both. And that will be a very difficult hill to climb. Secondly, if the economy starts to slow, I think the Federal Reserve will back away from a tightening policy until the inflation issue becomes so severe that it forces their hand. So I think we have some more learning to do about the effects of inflation, the willingness to stick to it. I think we have a long road ahead of us in addressing our fundamental structural debt problems and our inflation problems, both asset and price.
Let's talk a bit more about that. The Fed, based on your telling, is in a tight spot. How does the Fed, in the long run, get out of this trap? Is it realistic to expect the Fed to eventually reduce its asset stockpile at pre-2009 levels when it had fewer than $1 trillion in assets?
I think it'll be very difficult for the Federal Reserve to go back to $1 trillion of balance sheet. They can, I think, reduce it. I think that it'll take time. They will do it very slowly, I would suspect, because they do not want to disrupt the markets. But they can begin to do that. And the economy itself might grow into some of that. So you don't have to go back all the way to 1. If you could get back to 2 or 3, you've probably accomplished a lot in doing that. So I think that's possible. But the thing is, it won't come without pain. And that has to be understood by the Congress and by the public more generally. We have over a decade set a equilibrium for our entire economic system around a nearly zero interest policy rate. We have created enormous liquidity around that. So moving from zero to another level, to a level that constrains both asset and price inflation, will come with pain, will come with adjustments. The markets will see turmoil. I think we risk the possibility of a recession that we would have to get through. And if we back away too soon from a higher interest rate environment, we will just delay the reckoning. So we have to stick with it. And that's going to take a lot of will for the policymaker and for the public to understand and live through before we get to a stable long-term equilibrium with consistent 3.5% growth, which our economy, or even 2.5 or 3% growth, which our economy needs if it wishes to remain the strongest in the world.
Now, you mentioned stock prices and how they've been inflated in part by these strategies. With so many people having their money in retirement funds, seeing huge gains over the last decade, and given the Fed's actions over the past decade, it's hard to see the Fed moving aggressively enough or doing enough in such a way that it causes the stock market to really fall and cause a lot of pain for a lot of people. It almost seems like it's an impossible ask.
Well, I don't necessarily think it has to collapse. I think you have to put a consistent constraint, so it will grow more slowly as you get through it, and depends on what your pain tolerance is, if you will. But I think it can do that. But that's still hard because given we're used to these huge increases in asset values, getting used to modest or no increases in asset values will be difficult. It's a major adjustment. Now we can do it. We have a debt problem as well, where debt's growing faster than our GDP. So we know we have to deal with that. And our debt has to grow more slowly than our national income. And that's on the part of Congress to do that. If Congress does its part and the Federal Reserve then can do its part more modestly, I think you can, over time, over a decade or more, but probably over a decade, you can have the economy grow out of this dilemma to some extent. But it means it's not painless. That means there will be, I think, a higher level of unemployment over that period and slower asset value growth. And if we're willing to do that, we can work through this. If not, we will, I think, end up in a crisis mode as we did in 1980 with higher inflation and a very difficult adjustment.
Now, as you know, President Biden has nominated 3 people to serve on the Federal Reserve Board. They're down 3 members. They're viewed as having a more liberal bent. Do you think this is a wild card in future actions by the Fed? Could this prevent the Fed from moving as aggressively as it should? Or do you think that the danger of inflation is just so great that everyone's in the Fed at large will be on board with what they're doing?
Well, it's hard to know for sure, because until you're in that seat, you don't really have to make those hard choices. But my best estimate is that these are professional economists. They know the consequences of inflation. They have written about it. They understand it. And I think they will be on board with addressing this. I think their bias may be towards a more modest tightening, a more modest transition than you might get from a different FOMC. But I think they will go that way. I also think they will follow the chairman's lead. So the chairman has a lot to think about and to propose to the committee as a whole. If he does so in a convincing manner that we need to address this proactively, bring this inflation down, and we will have some market turmoil, and we may have some increases in unemployment, but we will get through this. I think he can lead them through this, but it won't be easy. And it needs the help of Congress. They really do need to deal with their spending. What happens if they don't? If the Congress continues to spend, they will need to borrow more money. That'll put enormous pressure on the Federal Reserve to buy that debt, to keep interest rates low, and to have a good market for that debt. That would be, I think, long-term, very harmful to the economy's ability to achieve a strong growth rate in the future and low inflation. It's a real challenge for both parties.
You know, it's not just government debt that has soared over the last decade. Corporate debt has also skyrocketed.
Yep.
Cheap borrowing costs obviously can affect how businesses spend and invest. How, in your view, have companies responded to uber low interest rates over the past decade?
Well, how the last part of your question, make sure I heard it correctly.
How have they responded to such low interest rates over the last decade?
Well, they've responded as they've been incented to respond. They've borrowed more. They've used debt to reduce equity because it's lower cost to them than the equity was. So they've levered themselves even more. They have, rather than in many cases, invest in new investment opportunities in terms of plant and equipment, they've decided to use these very low cost of borrowing to consolidate. And so you've had these what I'll call choices, allocative choices that affect the long-term health of the economy. Now, if you start raising those interest rates, these factors will affect their future choices because they have this heavy debt to carry. And if the interest rates are going up on them, they're going to have to adjust how they invest. I think you'll see more pressure on their balance sheets and therefore less stability in those markets as they have to adjust to a new world of higher interest rates. I think it'll be very difficult for them, but that's what lies ahead if they're going to address both asset and price inflation in the future.
Now, as you know, in 2007, 2009, a lot of people who were either retiring on the verge of retiring, end up getting hurt pretty severely by the decline in the stock market. If this turmoil that you're predicting occurs when the Fed moves to tighten, a lot of people naturally may be worried about what to do. How do retirees and pensioners protect their retirement funds given the scenario that you lay out?
Well, I wish I had a magic answer to that. I think they will see their assets under pressure. They will see them in some instances decline. Hopefully they have allocated enough in terms of the safe assets, lower return, but safer assets, that they can weather through this. But if they don't, then you wait until the inflation gets so high and the pressure becomes so great that you then have to take a strong action, and then their wealth really drops quickly and dramatically. So you want to avoid that as well. You have to have that, and you have to be aware of that possibility so that you can adjust more slowly. Yes, asset values will be under pressure, but they don't have to collapse if the Federal Reserve stays on a steady path to continued modest tightening to get the interest rates where they should be. And I think in the long run, that helps the saver, that helps investments, and that helps the economy. But it doesn't come for nothing.